Morning. The hearing on the Committee of Agriculture entitled Examining the 2017 Agenda for the Commodity Future Trading Commission will come to order. I've asked Michael Boss to open us with a brief prayer. Michael.
Please bow your head. Dear Heavenly Father, we thank you so much for this opportunity to be here today. Lord, we thank you for this nation. We thank you that we can live freely, that we can debate issues to try to make this nation a better place for our families, for the prosperity of this nation. We ask your blessing to be upon this nation. We ask you to protect our brothers and sisters right now that are in Puerto Rico and the things they're suffering through. Lord, guide the hands of the people that are down there working, that you bless them and you bring their island back. Lord, that they prosper, that the other areas that have been hit by such devastation as the other two hurricanes and the fires, Lord God, we just ask your protective hand be on all of our citizens. Lord, we praise you, we worship you. Guide us as we work on these issues today. Give us wisdom of Solomon. Lord, and help us to have the kind hearts that we need to have as public servants. We ask all this in Jesus Christ's name. Amen.
Thank you, Michael. Good morning. I want to welcome Chairman Giancarlo for being here this morning to highlight his plans for the CFTC. I want to first congratulate him on his nomination and confirmation as chairman. I count Chris as a friend, and I've enjoyed his counsel and the opportunity to work with him these past 3 years. He's going to make a fine chairman of the CFTC and have all the confidence in the world that he'll run that agency and the way we'd all like to see it run. I also want to thank our colleagues in the Senate for their quick action in confirming Brian Quintez and Russ Benham as the new commissioners. Having met with both these gentlemen, I know they'll be able and thoughtful commissioners. I'm also looking forward to the confirmation of Dawn Stump. The Senate's waiting to pair her with a nominee for the 5th and final seat, so hopefully that process moves along and we can finally have a full commission. The Ag community is deeply supportive of her nomination and is looking forward to having her perspective inside your building. Mr. Chairman, I appreciate your willingness to take a look back at the regulatory responses made to the financial crisis of 2008. Many of our members have been advocates of a comprehensive review of the CFTC's Title VII rulemakings. Too many end users and market participants remain adversely impacted by the sprawling, complex rules. I share your conviction that we can improve economic growth by reducing unnecessary regulatory burdens. I'm also encouraged by your vision for improving the management at the CFTC. You've said you want to make the CFTC a 21st century regulator, and I look forward to more details about Lab CFTC and the other modernization plans that you're proposing. You've also made structural changes and moved some personnel reporting lines, and I'm interested in hearing about any early payoff that you've seen from those moves. You've outlined an ambitious agenda that is headlined by 2 issues this committee has spent substantial time examining: the CEF trading rules and swap data reporting requirements. Progress on these 2 issues is critical to the success of Title VII reforms. The status quo will leave fractured markets and nearsighted regulators. I'm hopeful you can make meaningful headway on both these fronts. Finally, international issues remain front and center before your commission. As we've expected, trading venue equivalence is an important issue, and I'm encouraged by what I've heard in the news. But I'm also discouraged to read that CCP equivalence is again on the table. It's imperative that the U.S.-EU equivalence determination does not become collateral damage in the Brexit fight. You've talked about deference between international regulators, and I support that stand 100%. For 3 Congresses in a row, this committee and this House have passed strong language that would have enshrined principles of mutual deference to competent regulators into law. Excuse me. These markets are too big and too important to strangle with bureaucratic infighting. Again, thank you for coming today. And the time you and your staff have spent preparing, we look forward to your testimony and working with you over the course of your term. I now turn to the ranking member for his comments.
Well, thank you, Mr. Chairman, and welcome Chairman Giancarlo to the Agriculture Committee. You've appeared before the committee before, and you've actually played in the band here in the committee before. We welcome you. I'm looking forward to your testimony today on where we see the CFTC heading under your tenure. And I'm particularly interested in how you see the final implementation of Dodd-Frank. I'm generally been impressed with how the Commission has gone about enacting these changes and look forward to seeing continued efforts to continue to bring more transparency to the derivatives marketplace. I am concerned, however, that that Europe's rules for their version of our swap execution facilities don't provide anywhere near the pre- and post-trade transparency that our rules do. I understand that you've been negotiating on equivalence, this equivalence agreement and on those rules, and that you are close to reaching an agreement. So hopefully any final agreement will be more closely aligned with our transparency rules than theirs. The CFTC has a very important role to play, protecting the integrity of our derivatives market, and this protects not just those who use the market, but the economy as a whole. So thank you again for being with us today, and look forward to your testimony. Yield back.
Thank you, Ranking Member. The Chair would request that other members submit their opening statements for the record so that our witness may begin his testimony to ensure there's ample time for questions. I want to welcome to the witness table the Honorable J. Christopher Giancarlo, Chairman of the U.S. Commodities Futures Trading Commission, Washington, D.C. And Chris, I trust that you will not use your role in the ranking member's band and to undue influence over him as you play the banjo for the Second Amendment. So with that, Mr. Giancarlo, you're recognized. The table's yours.
Thank you, Chairman Conaway and Ranking Member Peterson and members of the committee. I'm honored to testify before you as Chairman of the Commodity Futures Trading Commission. In the 3 years that I've served on the Commission, I've learned a lot from you about the issues facing America's farmers, ranchers, producers, and other users of commodity futures products. And I've also traveled to many of your home states to meet with Americans who use and rely on our markets for these products. These visits have made me a much better regulator. I've also spent the past 3 years getting to know the agency, its staff, and its programs. And in that time, my respect has grown for the hardworking men and women who serve the CFTC's important mission. As you know, America's farmers and ranchers have used listed derivative products and markets for more than 100 years to hedge their costs of production and delivery. But derivative markets are not just useful for agricultural producers. They impact the price and availability of heating in American homes, of energy used in factories, of interest rates charged on home mortgages, and on the returns earned on Americans' life savings. They serve the needs of society to help moderate price, supply, and other commercial risks, and thereby free up capital for economic growth, job creation, and much-needed prosperity. That is why we must be diligent in protecting these markets from fraud and abuse. The day after the White House announced its intention to nominate me as chairman, I said, quote, "There will be no pause, no let-up, or no reduction in our duty to enforce the law and punish wrongdoing in our derivative markets." And I have kept that pledge and intend to continue to do so, and I look forward to detailing for this committee the CFTC's vigorous enforcement program. In preparing the CFTC's current budget request earlier this year, I reviewed the agency's various functions and expenditures. I identified several ways it can run more efficiently and save taxpayer money. But I also found areas where we need to devote additional resources. These include clearinghouse examinations, market economists, and technologists. And I'd like to discuss these needs with you today. I also look forward to discussing a new agency-wide review of CFTC rules, regulations, and practices to make them simpler, less burdensome, and less costly. This initiative is called Project KISS. Now, it's not about identifying rules for repeal. It's about taking our existing rules and applying them in ways that are simpler, less costly, and less burdensome, especially for smaller market participants and end users. I would also like to discuss another initiative, which we call Lab CFTC. It serves as a focal point for our efforts to facilitate market-enhancing financial technology innovation along with fair competition for the benefit of the American public. It serves as a platform to deepen our understanding of emerging technologies and their impact on American markets. Lab CFTC is meant to help the CFTC avoid being a last-century analog regulator of today's 21st century digital markets. Now, cybersecurity is certainly one of the greatest threats to market integrity and systemic stability of our time, and I look forward to reviewing for you the steps I've taken as chairman to address this ever-evolving challenge. One of my key priorities is to better coordinate the work of the CFTC and that of fellow regulators, including the SEC, and also the Fed when it comes to clearinghouse supervision. Equally important is to better harmonize our implementation of swaps market reforms with that of overseas regulators. I am committed to seeing that the CFTC's oversight of swaps and other derivatives is robust and effective, and yet compatible with overseas regulations to avoid fragmenting markets and trading activity. And to this end, I am hopeful that the CFTC and the EU will soon conclude satisfactory determinations on margin, on uncleared swaps, and trade execution. Finally, I look forward to resolving outstanding regulatory issues before the Commission, such as the de minimis threshold. Not just resolve it, but get it right, using the latest and most complete data to make a determination based upon true risk to the financial system. Yet it's hard to get something as complicated as this right when we are under a time crunch. On one hand, we are less than 90 days away from the new year when market participants will have to start counting the notional amount of their swaps transactions for de minimis purposes. On the other hand, we have 2 new commissioners and a new division director who are just seeing internal agency trading data for the first time. I'm reluctant to ask them to make such an important decision in a rush. I have therefore decided to request that the Commission delay this decision for 1 further year. We will follow the same procedural steps that Chairman Massad used last year to implement this 1-year delay. It will give the new commissioners and division staff adequate time to analyze extensive quantitative data, ask questions, analyze the answers, and arrive at a final decision. The goal is to get the right result, not a rushed result. Therefore, I intend to put before the Commission in the first half of 2018 a proposal for a final resolution of the swap dealer de minimis issues. I do not intend to roll over the decision on this issue again. Thank you for inviting me to testify before you to review issues of critical importance to the work of the CFTC and the American people, and I look forward to your questions. Thank you.
Well, thank you, Chairman. We appreciate you being here and your testimony. I've got something official to read real quick. Sorry about that. Members will be recognized in the, well, I lost it. Chair, remind members they'll be recognized for questioning in order seniority for members who are here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate members' understanding. So with that, I recognize myself for 5 minutes. Again, Chris, thanks for being here. Can you talk further about the broader statement, cross-border equivalence, deference, the things that are going on, and maybe help some of us understand a little bit better what the Brexit issue and what EU may be trying to do to take advantage of those changes to try to impose a regime that was not necessarily contemplated earlier when you did come to an equivalence kind of conversation with. So would you flush that out for us?
I'd be happy to. Maybe just a little bit of background to just sort of set the stage. Following the financial crisis in 2008, the world's G20 leaders met in Pittsburgh in 2009 and agreed on a number of fundamental reforms for the global swaps market, moving swaps off bank balance sheets to the extent possible into central clearing, having swaps transact on licensed and regulated platforms, reporting swaps transactions to central repositories, and then minimum capital and margin requirements. Personally, I agree with all of these steps and said so at the time and continue to believe they're the right steps. The question is about the implementation. Those G20 accords said that responsible regulatory authorities would implement these core reforms through their national regulatory and statutory processes. The United States went first. In fact, the CFTC went first, and by 2013 and 14, it implemented most of those changes and put them in place. We were a rule maker in regard to the implementation of these, and in many cases, did a very effective job. Other cases, I've been critical of some of the implementation, but not the underlying law. In other cases, such as clearing, we've been wildly successful, and now we're actually dealing with the second and third order impact of those changes. Well, other jurisdictions haven't been as quick in putting their rules in place, and in many regards, Europe is today getting ready to put in their big implementation, something called MiFID II, which comes into effect in January of 2018. Since that time that our rules in effect, we've learned a lot about them, and Europe has come to a point where they're now determining that our rule sets are either equivalent to theirs or not equivalent to theirs for purpose. And we have a number of important outstanding equivalence determinations that we have been working here at the CFTC very diligently with our European colleagues to get to a final resolution of, and as I mentioned in my opening remarks, I'm hoping we will soon be there. But on the on the subject of clearinghouse supervision. This is a very important issue, and it may be an issue of some degree of tension between us and Europe. As I said to you, the United States is a rule maker. We are not a rule taker. And this is a concern in the wake of the Brexit exit, that Britain will be taking a lot of its swaps rules wholesale from Europe. And Europe is now reformulating some of its rules in terms of clearinghouse supervision to have a third country approach where they propose that they will have direct oversight of third country clearinghouses, which in some cases could export European substantive law into the way our clearinghouses operate. Well, again, we are a rule maker, not a rule taker in the United States. This Congress decides what our law should be and charges our agency to implement it. It doesn't tell us that we have to abide by foreign country substantive law. So this is an area where we're working carefully with our European colleagues. We're making them aware of our concerns. I've just finished a 10-day visit to Europe where I had both private visits and some public statements, and even did an op-ed in French in a French newspaper to get our point across that we were the first to adopt these rules. We will continue to be diligent in our implementation of reg reform, but we are a sovereign nation and we have a sovereign approach to these rule implementations.
I didn't realize you were fluent in French.
With a little help of a good translator.
Well, I appreciate that. Again, appreciate your leadership at the CFTC. Look forward to working with you on a variety of issues, including reauthorization, funding levels for your agency, all those important questions moving forward that we have a common interest in getting those done and done as quickly as possible. So with that, I yield back and I turn to the ranking member for 5 minutes.
Thank you, Mr. Chairman. Following up on that regard, I remember when I took the committee over to Europe and when we were doing all of this stuff way back when. And we had people there tell us, that they were shopping for the lowest level of regulation using, well, actually some of our companies in the U.S. were using London against New York in terms of, saying, well, if you don't give us what we want, we're going to go over to London. Clearly they were doing that. And, what I'm concerned about is that apparently this Claris found that under the European rule that they've set, 80% of the swaps would have no pre-trade transparency, and that 75% of the risk traded will remain dark for a month. So what I'm concerned about, are they going to try to set up some kind of regime where they're so upset with London that they're going to try to start using, negotiating against each other to try to weaken these regulations as part of their war with London? I'm sure you're well aware of all of this stuff. So do you think that your negotiations are going to be able to overcome this and end up, because my concern is that we continue to have a system that works and transparent, so we don't ever get into a situation like we were in, in 07 when people didn't know who could make good on the risk, and the whole thing just about came apart. So,
oh, thank you for that question, Ranking Member. At the heart, as you rightly said, at the heart of the crisis back in 2008 was a lack of visibility, both for regulators and for the marketplace, into the counterparty credit exposure of one large bank to another large bank. And that led to an old-fashioned run on the bank and full meltdown financial crisis. And fixing that risk profile transparency, I think, is one of the most important imperatives to come out of Dodd-Frank and Title VII. And the shame of it is that here we are 9 years after the crisis, 8 years after the Pittsburgh Accord, 7 years after Dodd-Frank, and we still don't yet have the full mechanism in place to give us that full visibility into counterparty exposure. Now, it's not for a lack of trying. We have created the swap data repositories. We're collecting the data, but we're trying to bring order to a world in which every bank had a different protocol for how these trades were recorded within their own back office, let alone reported to regulators. We have different nation and jurisdictional methodologies reporting methodologies. Now, we at the CFTC are working very closely in international bodies at IOSCO and others to try to get these transaction identifiers right, and yet we have our own work to do in putting our own systems in place to do this. This is an imperative, and it's one that I'm committed to following through at the Commission. Now, you mentioned the European approach to transparency. I am concerned about it. There is a lot of discussion on transparency, but as we understand the MiFID II requirements, there's also a lot of exceptions to their own transparency requirements. So we're still understanding that. At heart, though, I'll say one thing is I do believe that for the most part, market participants don't search for the lowest common denominator when it comes to regulation. I think they search for the best. I think it's our job as regulators not to focus on whether we have the least amount of regulation, the most around. It's got to be to have the best regulation, the regulation that achieves the core principles and the guidance that Congress sets for it, but does it in a way that is sensible and is in tune with the market itself. And I think that's what we search for, is what is the optimal way to achieve the policy goals that Congress sets for us.
When do you think these discussions are going to end?
I think they're going to be going for a long time. I mean, harmonize. So the Pittsburgh Accords, when they called for these implementations, they said what we must do is implement them in a way that's compatible. And trying to get the compatibility right is a long and complicated process. I think we'll be at this for some time. I wish it were simpler than that, but these are complex markets. It's a complicated regulatory landscape.
Thank you. Thank you, Mr. Chairman.
Jimmy is back. Mr. Lucas, 5 minutes.
Thank you, Mr. Chairman. Chairman Giancarlo, let's pull back just a little closer to home for a moment for what I hope would be a brief series of questions. The Treasury released last week recommendations that CFTC and the SEC harmonize their treatment of inter-affiliate margin. And I know that your agency has been willing to acknowledge that these swaps are not presenting systematic risk to the wider market. But the banking regulators have yet to come around to that point of view. Would you agree that these two approaches should be harmonized? And briefly, how do you think, if so, how do you think the two agencies can go about it?
Thank you for that question. As soon as Chairman Clayton at the SEC and I settled into our chairs, we reached out to one another and agreed that there's a whole range of issues that deserve considerable amount of high-level attention at our agencies to resolve between our two agencies. And we've established now a chairman-to-chairman ad hoc working group led by his chief of staff and my chief of staff that meets several times a month, starting with a list of unresolved issues that we've been going through one at a time. And it led to recently a chairman-to-chairman meeting with our full staffs to go through these issues. And we will be now meeting every several weeks at the chairman-to-chairman level in addition to our chiefs of staff meeting more routinely, going through an issue. And I hope that by the end of this year, we will have some announcements to make about having made progress on that. But your point about compatibility, the one thing I would say is we need to get to a balance between the banking regulators' approach to swaps reforms and the market regulators' approach to swaps reforms. They need to be balanced out. I think that in some cases, bank-driven concerns over bank solvency have overridden concerns about market trading liquidity, and I think in a healthy approach to swaps reform, we balance the concerns on both sides.
In the past, Chairman, you have pointed out that the risks that come with the government agencies gathering highly sensitive trading information. And I agree with you on that score, particularly pertaining to last year's Regulation AT proposal from the Commission. These fears seem particularly appropriate given the SEC's Edgar hack in the last month. So, Chairman, I guess what I would ask is this. Should farmers and ranchers be concerned about a trove of sensitive trading information being hacked at the CFTC and then used to upset the various commodity markets? Is that a fear we should have?
I think we all need to have a healthy, mature concern about cyber crime, cybersecurity in this day and age. I've told my staff that we should do everything we can to prevent it. But sometimes we have to think about it as not a question of if, but a question of when, and how do we minimize the damage. And to that end, I recently instituted a new instruction at the agency. We are in the process right now of doing three things. One is cataloging every use we have of PII, personally identifiable information used by the agency. Secondly, once we've identified all of it, we will then determine where we can either eliminate or reduce our collection of PII. And then third, for that PII that we determine we do need to continue to collect, what will be our best practices in how we protect it, how we limit its utilization, how we cyber encrypt the information, and what is the duration by which we'll keep it before we will destroy it. So we're taking 3 steps to identify how we use personal information, and hopefully that will reduce the likelihood that if and when we are hacked, that information will get out into the wrong hands.
In February of last year, the Commission negotiated a common approach for recognizing transatlantic derivative clearinghouses as equivalent with the EU. For a moment, since I serve on a number of committees that look at a number of things from a number of different perspectives, let's say Congress repealed the orderly liquidation authority for systematically important clearinghouses. How would that affect the equivalency determinations enjoyed by U.S. clearinghouses now?
Thank you. A very important question. The situation prior to orderly liquidation authority, in the event a CCP, a central counterparty clearinghouse, needed to be resolved, is Title VII in bankruptcy. That is full wind down under the oversight of a trustee in bankruptcy. I mentioned that some of the reforms of Dodd-Frank have been wildly successful. One is the clearing mandate, which has now caused the supersizing of a number of swaps clearinghouses. Putting a swaps clearinghouse of enormous proportion into Title VII bankruptcy is not a good outcome. So if Title II is repealed, we're back to the situation prior, which is not optimal. I think what we need to do is take a look at Title II, which was designed for banks, and think about how it should be retailored for use by these new supersized clearinghouses, which in the event of a crisis actually need to be run in a very orderly fashion to maintain orderly markets for what could be a lengthy duration of time, not wound down in an immediate fashion for the benefit of either creditors or depositors, which they don't have.
Thank you, Mr. Chairman.
Chairman Joseph, David Scott, 5 minutes.
Thank you, Mr. Chairman. Chairman, I strongly believe that we certainly, on the issue of cross-border, that we've got to continue to press for U.S. interests, but ultimately make principle-based agreements with foreign regulators so that we can continue to promote cross-border businesses. Now, our American market participants and other exchanges like ICE from in my district in Atlanta and clearinghouses, they need to continue to have access to the European market in a fair and reasonable way, not economic silos. Do you agree with that?
I couldn't agree more. I think you stated the balance exactly right in your remarks. We need to work with our overseas counterparts to pursue the core principles of these swaps reforms, but do it in a way that advances American interest. And finding that balance, I think, is the critical important task for us at the agency.
Yeah. Now, one thing that disturbs me about this Brexit situation in relationship to that, are you aware that a fight has erupted between the United Kingdom and EU, of course, since this Brexit, regarding the location of important derivatives clearinghouses, such as LCH. And the EU has even threatened to impose or either enhance supervision on these so-called relocation requirements. Are you aware of that?
I'm very aware of it, following it very closely, Congressman.
And what is your concern with that?
If I can be a little colorful on this, I'm concerned sometimes. I feel as if the United States are being treated as the children of a divorcing couple.
That absolutely, I couldn't have said that any better than that. And so you can see my position, and you're familiar with the Intercontinental Exchange and the great work that they're doing. So now let me go to one other point on this de minimis question. I'm concerned that it could have devastating consequences if we lower it to $3 billion. First of all, it would limit our bank's ability to provide the risk management solutions for our customers. And then secondly, it would raise the cost of providing the hedges that are so important for risk management. And so my question to you is, considering how long this has been going on and how soon action is needed, and you touched upon it in your remarks, but will you pledge today to not lower that level from $8 billion?
Well, let me say this. As in most of these things, there's a careful balancing that needs to be done here. The balancing is, one of the core reforms is that swap dealers would be subject to registration. And this issue then becomes, what is the lowest, what is the de minimis of that? Where is the cutoff? We want to get the cutoff right, whether it's at 8 billion, 3 billion, or any other billion, where we keep market participants making markets and serving, especially the smaller market participants. At the same time, we honor our obligation to register them. Okay. So what I will pledge to you to do is to get the latest and the very best data, to put it in front of my commissioners and ask them at what is the right level where we keep the amount of market making going on in the market so our smallest market participants have access to it, and yet we honor our obligations to register those who are truly swap dealers. And and my goal is to get to the right outcome of this.
Very good. Finally, I serve as the co-chairman of the FinTech Caucus, and I want to get your opinion on what you see the future as far as regulation. Now, as you probably know, the Office of the Comptroller General of the Currency has indicated that they want to now put a special order charter on these fintech companies, which means once that happens, they have to register with the federal government. Once they register, then they're going to come under all these regulations from a variety of different sources. And in your case, you have a unit that you're dealing with to look at this. So does the CFP. Their unit is called Galaxy.
Yep.
And so is the Fed. So all these regulators now are itching and looking to how to regulate. And the biggest problem that the fintech companies have is, what do we do about this? And so I would like for you, if you could, my time is up, so maybe we can look at that.
If I could respond, thank you. If I could respond briefly. Just at the risk of overgeneralizing, these new innovators come in two buckets. They are either the quintessential small garage startup new company, or they are big incumbent operations like some of the big Wall Street banks and other big players. My fear is if we go to a charter basis, the big banks and all will have no problem meeting all those requirements and hiring the lawyers and everything else that you need to do it. And the small firms will simply say, we'll go somewhere else. We're having a hard enough time doing accounting and payroll, let alone being able to hire the lawyers and everything necessary to get one of these charters. And so we'll have shifted the balance of power in favor of the big firms. And as we know in our own American experience of the last 30 years, sometimes it's these small innovators that bring some of the most fundamental change to markets. We don't want to disadvantage the small players. We want a balance between the big and the small, because where the best innovation comes, we don't know. We want all sides of the equation innovating and bringing those new evolutions to our markets, hopefully to better our markets. And that's our job, to make sure they better our markets.
Thank you, and thank you, Mr. Chairman, for giving us a little extra time.
Austin Scott.
Thank you, Mr. Chairman. I was somewhat laughing at my colleague David Scott from Georgia's question and how good it was, because the one that I had written down dealt with financial technology, and you've answered part of it, but now we've got a little time. Maybe you can elaborate, Commissioner. The global contest in this area, is the U.S., are we ahead of other countries, or are we behind other countries with regard to encouraging the development of this financial technology? And are there certain countries that we need to catch up with?
Yeah. So there was a study done by one of the big accounting firms a year or so ago, and it ranked countries on the fintech and what we call regtech innovation going on in those jurisdictions. And it looked at the major jurisdictions of the California, divided the U.S. into California and New York, and looked at London, Hong Kong, Singapore, Australia, and Japan. And on the case of financing, access to technology talent out of the university, the United States ranked #1. But when it came to the regulatory environment, the United States ranked dead last. Our competing regulatory jurisdictions, especially in London, but also in Hong Kong and Singapore, are way ahead of us. They've developed what in the UK they call Project Innovate, where they work directly with fintech companies. They have, I like to say what they've done is they've taken their old limestone building and smashed a new doorway that says innovators come in here. And innovators can go in and say, look, here's what we're trying to do. And there'll be somebody that says, well, you know, our rules don't let you do that. But we'll put you into a special innovation center where we'll allow you to innovate. You'll work with you know, some young technologists on the staff of the Bank of England or the Monetary Authority of Singapore you'll keep them apprised of what you're doing, you'll do your innovations, and then we'll see whether we need to amend our rules to allow you to do that. That's what we're trying to do at the CFTC, but we're sort of unprecedented. This hasn't been the U.S. government response to innovation, and so the answer to your question is we are definitely behind our fellow international regulators in this area. We need to catch up, I believe.
So just a quick follow-up to that. You're talking about trying to make changes by rule, and my question as a follow-up would be, do you have the regulatory authority now that you need, or do you need additional authority through legislation to help you accomplish this?
We are going to need, at some point, additional authority through legislation.
Okay.
What we're trying to do in the interim, though, is really understand and fine-tune what that is. We have a rule book and a set of regulations, CFTC, that was written for the 20th century analog markets, those markets that we're all familiar with, we see in movies of trading pits and hooting and hollering and shouting. Those trading pits are all closed. And yet our rule book still recognizes floor traders and floor brokers, categories that don't exist anymore. Our rule book was written for a trading world that existed last century. The markets have moved on, and yet we've got to catch our rule book up to the way the markets are today, and that's what we're trying to do with our lab CFTC.
As you have recommendations for the language in legislation, if you would let us know, I imagine my colleague Congressman Scott and I can probably find agreement on that. Look forward to working with you on it. One last question: the issue of self-reporting. There's a lot of criticism of self-reporting in the media. Seems to be criticism of virtually everything in the media these days. Can you explain the rationale behind encouraging self-reporting?
I'd be delighted to. And I can explain this on a number of levels. The criticism that's been in the media has run the gamut from, in the New York Post reported that we're using South Bronx tactics to go after, you know, white-collar defendants. And you know, on the other side of the spectrum, we've been accused of waving the white flag to Wall Street. So the criticism has been all over the place. Thank you for the question, because I really want to address this head on. And let me start with how the CFTC prosecutes wrongdoing. We have three traditional ways of finding out about wrongdoing, all three of which we have enhanced in the last 6 months. Not shut down, not diminished, not wave the white flag. Our three traditional ways. One is our own internal surveillance. We've enhanced that by actually moving it into our division of enforcement so it's more efficient in terms of uncovering wrongdoing. Secondly, we rely on tips and referrals from other law enforcement agencies. We've enhanced those relationships to make those tips received by us more efficiently. And finally, we have a whistleblower program. We've enhanced that by adding new protections for whistleblowers, so to protect them, to bring items to our attention. All three of those methodologies remain in place. Our new cooperation agreement is an additional fourth channel that we've added to that. And what this is a way of us having companies themselves, if they become aware of wrongdoing, report that wrongdoing to us so that we can then act on it. Now, my light is flashing, so I think I'm running out of time. I would like to talk about this more. If there's a further follow-up question, I want to talk more about this specific program.
Chairman, thank you for your service and your family service to the country, and thank you for visiting Georgia.
Thank you very much.
Gentleman's time expired. Mr. Maloney, 5 minutes.
Would you like to finish your previous answer, Mr. Chairman? I'd be curious to let you do that.
Thank you very much. I want to give you just an example of where I think this cooperation program can be really useful. Just picture a CEO walks into his office at 9 o'clock on a Wednesday morning, and standing outside is his chief compliance officer, and he says, "Sir, we've got a problem. We just discovered that Joe Bloggs on one of our trading desks has been engaged in completely illegal conduct. It's just come to our attention. I'm bringing it to your attention." Well, the CEO rightfully says, "Take him off the desk, send him home, let's investigate and find out what's going on." A month later, he gets the report. The report is this guy was a lone actor. As soon as they discovered it, they took him off the desk. It seems like he was acting alone, but they know it was wrong. The CEO at that point is faced with a choice. One choice is to fire that employee, say nothing further, and be done with it. The other choice is to report it to the regulator. Up till now, if they report it to the regulator, they're subject to the full panoply of punishment for doing that. So unfortunately, the choice that may be more likely to be made is that employee is fired and nothing more said about it. And the problem with that is that means that employee then goes across the street, gets a new job with another firm, and starts the same nonsense all over again. And we as the regulator don't get to take that person out of the marketplace.
Okay, if I may,
Yes.
I'm reclaiming my time,
Yes.
as my colleague would say.
Of course, I'm sorry.
Maxine Waters. I'm interested in that, but I'm also interested in systemic risk. What are the sources of systemic risk right now that we're not paying enough attention to?
That's a great question, and it's a complicated one for...
You want to start with clearinghouses?
Well, so we're in some ways the victim of our own success. The swaps clearing mandate has been wildly successful, but I'm not sure we fully thought of the dimension. So today, the London Clearinghouse has eclipsed the Chicago Mercantile Exchange as the world's largest clearinghouse measured by initial margin.
Right. What happens if it fails?
Well, failure in the swaps world is complicated because clearinghouses traditionally don't fail.
I know.
What they do is, though...
But they're different now, right?
They can suffer short-term liquidity crunches where they have to pay initial margin or a variation margin in cash, and they have to convert collateral, often very good collateral, like T-bills and cash-like debt, but they have to convert it quickly into cash. For our domestic clearinghouses, they have a facility under Title VIII of Dodd-Frank with the Federal Reserve that can give them short-term liquidity lending. For overseas clearinghouses, they have the Bank of England, but they don't have direct access to our Federal Reserve. And yet, something like 50% or so of what is in the London Clearinghouse is U.S. Bank, and something like 44% is that U.S. dollar denominated. That's a concern. Another concern I have is a consolidation that's taking place.
I'm sorry, just
quickly,
what's the concern? The concern is that the Bank of London doesn't care the way it should about bailing out U.S. companies.
The Bank of England is a very good regulator, and I have confidence in their ability to act quickly, but they would be having to act quickly with dollar facilities for those dollar deposits, and they may then need to turn around and use what's called a swap facility with our Federal Reserve to back that up. Now, I've spent time with the Bank of England. I believe the processes are in place for this. But in a fast-moving crisis, this could be a point of a fair amount of concern and tension.
Less than a minute. Besides the clearinghouses, what are your other systemic risk concerns?
You know, there's always concern with swaps when you combine the complexity and the leverage that's involved in them. And that's one of the reasons why I think a lot of the reforms are the right reforms. When we register swap dealers, we inspect them. We want to make sure they understand how these products are used. We need to understand that the actors in this, and it's why I've put forward a proposal to actually license intermediaries in this market, brokers in this market. It's not something that's in Dodd-Frank, and I feel it should be, and it's something we feel that the agency we can do, so that we make sure that the market participants themselves are knowledgeable in these products.
Thank you, Mr. Chairman. I knew you when you were a successful entrepreneur in New York City in a space that was similar to the one I was in, and you had a better business model. So I'm very happy to see you
It's nice to see you again. Thank you, Congressman.
Jimmy goes back. Mr. Crawford, 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, thank you for being here today. Back in June, this committee heard testimony supporting granting clearinghouses access to account services and limited discount window access at the Fed. Do you think extending such services to all derivative clearinghouses would help avoid a taxpayer bailout and reduce systemic risk, and if so, why?
So I want to distinguish too big to fail, TARP-like bailouts of clearinghouses, which I think would be extraordinarily unforeseeable, with the two facilities that are available in Title VIII, which is depository facilities. One, actually, to Mr. Maloney's question about systemic risk, one area of systemic risk is these clearinghouses are collecting all this margin, and they're putting it with the same 3 or 4 custodial banks. Being able to put that money on deposit into the Federal Reserve System, I think, is a very valuable element of Title VIII, and I think that's a value, and that's not a too big to fail. That's simply putting up cash assets into a Fed Reserve account. And the second one is short-term liquidity provision in the event of a short-term liquidity crunch where these clearinghouses will be able to put up good assets, again, in terms of short-term cash liquidity on either a day or intraday or a several-day basis. I think those are healthy facilities that could actually forestall a crisis.
Thank you. I want to switch gears a little bit, Chairman. This is the Ag Committee, and I want to talk about ag commodity trading as it applies to everyday farmer who's making decisions about risk management and how they deal with that day to day. Former Series 3 license holder, don't pretend to know much about the commodity markets other than, as you described, a broad range of commodities under your purview. But I want to focus on the ag side just a little bit. I have a theory, and you could either debunk this or validate it, whatever, but I have a theory that if we have more actuals in the market, and I'm talking about commodities agriculturally, if we have more actuals in the market, we reduce volatility. Would you agree with that?
So there's a lot of new and emerging econometric views of markets. There's something called the adaptive markets theory that's come out of a professor named Andrew Lowe at MIT that talks about markets like ecosystems. Mm-hmm. And in the natural world, the healthiest markets are the markets that have the greatest amount of biodiversity. Mm-hmm. And the market environments that are the least durable and the more prone to market shocks are the ones that have limited biodiversity. And I think we see a similar thing in our markets, those markets that have the greatest multiplicity of market participants of all stripes, naturals, long-term hedgers, short-term hedgers, speculators, are the ones that are the most durable. And the ones where you have a small amount of market participants or of a similar trading style are the ones that are least durable. And I think our goal as market overseers ought to encourage the greatest diversity of market style, market strategy into marketplaces. And that's what we seek to do, is to increase the biodiversity, if you will, of our markets.
Sure, let me throw this out. My fear is that as we've discussed this, and it's been an interesting conversation we've had thus far, but I'm thinking folks that are watching this on C-SPAN, literally tens of people that are watching this right now,
with their eyes glazing over, at least when I'm speaking.
I have kind of zoned out because and that's sort of the sense that I get from farmers, is that they have been relegated to purely price takers, in that spec traders on either side are now responsible for price discovery. And there used to be a true price discovery in there for them, and that's when we saw probably more of a willingness for agricultural producers to become hedgers, because they're already in the market, they're already long actuals. So they need to hedge, they need to be short. But trying to sell that to a farmer with all that we're talking about right now in broad sense, it's putting a lot of fear out there. And so my point is this: we're relying almost exclusively on spec trading for price discovery. Your thoughts on that?
I worry about that too. And one of the things that we aim to do in our budget is really double the size of our econometrics unit. The CFTC used to be an agency driven by economics, and that's really winnowed down over the last decade. And we really need to, because we need to understand the impact of these new market participants in the market. There's no magic wand, but it has to start with better intelligence about how our markets are changing as we go into this digital environment. I'm very concerned, but I don't want to take action based upon fear and worry. I want to take it based upon sound economic understanding as to what are the impacts of some of these new non-traditional players in our ag markets.
Thank you, Mr. Chairman. Yield back.
Mr. Evans, 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I'd like to follow up on something that my colleague was raising in terms of what can you think of laws or regulations that have changed with Dodd-Frank that still needs more refinement. It looked like you had started to talk about that. You mentioned specifically some things that was not in Dodd-Frank. Can you go back to that aspect of it?
Sure. So if we take the core reforms in Title VII that the CFTC was charged to implement, starting with probably the one that was most fundamental, and that was the clearing mandate.
Right.
The CFTC's implementation, as I said, was wildly successful. And now we have the second and third order ramifications of that, and that is the supersizing of some of our clearinghouses, including one in particular that's not even on American shores. And we have to face up to that challenge in an environment where even the European regulatory response is changing because of Brexit. That's a very complicated one and will play out, I think, over the next year or so. The second mandate that we implemented was swaps data reporting. And as I mentioned earlier, a vitally important reform, one that I fully support. For different reasons, we haven't achieved its ultimate objective. It was an enormous undertaking.
You said we have or have not?
Have not. I'm sorry if I didn't articulate. Have not fully achieved that. I'm committed to doing it, but it's a big project, and that is because the marketplace itself had no agreement on what were the right ways of identifying transactions. They called the same instruments by different names throughout the marketplace, and different nation states have different approaches to this as well. So it's an enormous task. We must get it done. The third implementation was the one that I've personally been most critical. I believe in the need to regulate and register swaps intermediaries, what are called swap execution facilities. But I believe that the CFTC in its first crack at this got it wrong for two reasons. One is it didn't follow the instructions of Congress. Congress said that swap execution facilities should be able to use any means of interstate commerce to transact. The CFTC said, well, you can have any means as you want as long as it's either the two types we're prescribing. And the two types were types that come out of the futures world, not out of the swaps world. So they used the wrong model on this. And so I wrote a lengthy white paper 2 years ago laying out an approach that I think is more consistent with Congress's instruction there. So those are the three major rule implementations that we have done. And moving forward, what I believe in the three principles, what we want to do is optimize their implementation in a way that is healthy and is appropriate for our markets.
You also said something else a few minutes earlier. You talked about the rule book being established at one period of time, and then you talk about the modernization where we are in the 21st century. How do you reconcile that aspect, and what recommendations do you make to us to try to, and somewhat, reconcile that challenge?
So I believe it is the case that we have a rule set that was pretty much originated. Our agency was founded in 1975. Most of our cores were written in the 20th century. And yet our markets are changing dramatically in front of our eyes. You know, a quick experience I had visiting a farmer in Texas a year ago, he showed me how he was able to cut a field in the middle of the night in pitch darkness using GPS satellite guidance for his combine, vehicle telemetry for his tractor, and a drone to be able to film the entire scene. He and his son cut the entire field in the middle of the night. So farming, an activity that's as old as mankind, has always been a daylight activity, thanks to digitization, is now a 24-hour-a-day activity. And that type of digitization of farming is mirrored in our markets as well. Our markets are being dramatically changed by these new exponential digital technologies, and we need to keep up. Now, there's an old doctor adage, first do no harm. I think we need to be careful how we make changes in a rule book. They need to be appropriate, and we need to start with understanding the impact of these new technologies on our markets, understand it thoroughly so we can update our rule book in line with hard data as to how our markets are being affected by these new digital technologies.
Yeah. Thank you. Jim and just back. Thank you. Mr. Comer, 5 minutes.
Thank you, Mr. Chairman. My first question is going to revolve around digital currency jurisdiction.
Yep.
Bitcoin and distributed ledger technology are the subject of many interesting regulatory questions today. For example, the CFTC asserted jurisdiction over digital currencies such as Bitcoin, calling them commodities, while the SEC asserted jurisdiction over DAO tokens, calling them securities. Similar questions arise in connection with the treatment of distributed ledger technology by other regulators. What can you do to help clarify the regulatory treatment of these new technologies?
Yeah. So here's a perfect example of how our rules and SEC rules were written for a time before there were digital currencies. And what we now need to do is reinterpret these rules in light of this very fast-paced technological innovation, which are these cryptocurrencies. And it's a volatile environment. It's one that's evolving very, very quickly. And so what we're doing at the Commission is just calling it straight down the line. We're approaching this like a good umpire. We're calling balls and strikes. We read our statute and the definition of commodities to involve these new instruments. And you mentioned that we registered a cryptocurrency exchange. We did it because they met our requirements. And I had our lawyers go through it carefully and say, yep, they meet the requirements, so we registered. We also, however, have just taken on a Bitcoin Ponzi scheme because we also believe they're meeting our requirements, but in the wrong way, and are violating those. So we're playing this straight down the line. We're interpreting our rules in light of this new technological innovation, and we're looking at this very carefully and very thoughtfully, but we have to reinterpret a rule book that was written before those came into existence for the world that we have today.
Okay. Switching gears, the Volcker rule is currently administered by 5 agencies jointly, including the CFTC. The Treasury Department recently criticized the rule for its extraordinarily complex and burdensome compliance regime, which hinders both market-making functions necessary to ensure a healthy level of market liquidity and hedging necessary to mitigate risk. What role do you think the CFTC should take in the future implementation of the Volcker rule, and how do you scale that to your available resources?
Yeah. So I think the Treasury Secretary has taken the lead on this, and it's in the Treasury report, and the administration view is not to call for the repeal of the Volcker rule, but to make it suitable for our markets and ultimately suitable for broader economic growth and market health. And I believe that is the right course. We'll be in the boat rowing on fixing the Volcker rule, but we won't be the lead oar that will come out of Treasury. And we look forward to what recommendations made. As far as from a market's point of view, my concern with Volcker is that it be conducive to healthy market activity. There is some presumptions built into the current definition of the Volcker rule that presumes that activity is impermissible proprietary trading as opposed to permissible market making. And I have some questions with some of those presumptions. They don't seem to be based upon market reality. They seem to be based upon maybe a bias against markets. And as a market regulator, we're very concerned where we believe there's bias against healthy market activity.
Mm-hmm. With respect to position limits, the SEFs are required to set position limits, but have no view into the overall positions held by people who transact on their platform. Does it make sense to eliminate this requirement?
It's a very complicated area. The nature of the swaps market is to have multiple execution points unlike our futures market that has one execution point for most of the listed products. So it is complicated. How do you have a uniform position limits when it's actually implemented at multiple points who don't necessarily have a means of communication? Which is why before I went into government, I actually proposed to the CFTC a public-private partnership to form a council that would agree on position limits and apply it across. And that's something we're still looking at the Commission, and we'll continue to look at as to whether that might be a solution to this.
Thank you, Mr. Chairman. I yield back.
Jim yields back. Mr. O'Halloran, 5 minutes.
Thank you, Mr. Chairman. I guess my problem right now is I have so many notes, I can't organize them fast enough. But I have as many concerns also. Your testimony basically has said to me that after 9 years, we are not where we need to be. And that I don't think, in my experience with the CFTC, I have never seen a time when you were funded appropriately to be able to meet your mission statement at all. And so I don't think you're funded appropriately now either. But, and you had stated there's more knowns than unknowns. I don't know about that. I'm sorry, there's more unknowns than knowns. That's a concern, given your current position. And my math is bad too, as it appears. So after all that diatribe, please catch up with me.
Thank you, Congress. Well, now my notes are all over the place, and I'll try to respond if I could. Thank you for the shout out on our budget. As you know, we did use bypass authority to seek a 12% funding increase over the budget put forward by the White House. I just want to, you asked about what's the strategic vision. I think the strategic vision is twofold. One is, I am committed to the core reforms of Title VII. Personally, I was committed then, I'm committed today, and my goal is...
You don't have the resources to get there.
Well, we have asked for a 12% budget increase, but within that, I think we can achieve a lot. Secondly, even with those reforms, Title VII doesn't address some of the biggest challenges we have today. Cyber is not addressed in Dodd-Frank. The digitization of our markets, not addressed in Dodd-Frank. The fragmentation of our markets, not addressed. The consolidation of market participants, including the consolidations of the futures commission merchants industry, not addressed. So we're committed to completing that, but we also have to look forward to these other challenges that are not addressed, and that requires market intelligence. We really need to understand these changes. I do want to address the issue on...
I hear a tapping behind me.
If I could just, on the Wall Street Journal piece, that compared the first 6 months of this year, as we explained to the Wall Street Journal, all of those cases were started under my predecessor. So if they're disappointed in what's been done in the first 6 months, they're really addressing not my agenda, but the previous agenda.
Gentleman's time has expired. Mr. Boss, 5 minutes.
Thank you, Mr. Chairman. Chairman Giancarlo, the ongoing conflict between the UK and EU over Bredex has introduced significant risk to swap clearing. The EU may require euro-denominated swaps to be cleared in the EU. Alternatively, the EU may impose strict supervision requirements and clearinghouses outside of the borders. Now, you may have, because of the luxury of this place, I'm bouncing from one committee to another, so you may have answered some of these questions already, but I've got 4 specific questions, and I'd like to have them addressed today if we can. How might this affect the U.S. clearinghouses? How might it affect the U.S. swap markets? Why would we allow the EU to disrupt the equivalency agreements? And what can we do to make sure investments are adequately protected? Those are the 4 questions I've got.
Thank you very much. The last one was investments adequately protected. So it will affect our U.S. clearinghouses. As I read the European proposal, they would export European substantive law, MIR, on the operation of our U.S. clearinghouses. They also would have a role for the European Central Bank in overseeing our clearinghouses. This is something that's unprecedented. Our Federal Reserve has no role in clearinghouses offshore. So yes, it would affect our U.S. clearinghouses. It would also affect U.S. markets. We think it would lead to a greater fragmentation of markets. And as I use that analogy of markets like ecosystem, when you fragment ecosystems, you weaken and create potential harm to ecosystems. And we think fragmenting markets is an existing problem which would be exacerbated by this proposal. On the third point about the existing equivalence agreement, where I come from, a deal is a deal. We reached a deal, and I give credit to my predecessor, Chairman Massett. He spent 3 years working on that deal. Concessions were made to reach that deal with the Europeans. A deal is a deal. And then on investments in the market, you know, whether the investment is shareholders in our clearinghouses, whether it's investment shareholders in other elements of our financial institution, a wholesale change like this will have impact on investment and the investment returns for market participants. So all 4 of your concerns are concerns that we share and will be addressing in the months to come.
So what is the answers that we can do from this committee from a legislative standpoint to give an opportunity to protect our investors?
Well, I think the signals to the Europeans that the United States is a rule maker, not a rule taker. We were the first rule maker when it came to the implementation of the Pittsburgh Accord swaps reforms, and in many ways we did a mighty fine job of it. And while we respect the Europeans' process of coming to their rule sets and rule making, again, we're a sovereign nation. This Congress makes the laws, this agency implements the laws, and we've been doing this for a long time, and for the most part, we're doing it quite successfully. Not in every case. We can always improve, and we can always do better, but we certainly are recognized as the world's leader in derivatives regulation. This committee has a very important role to play. We are a rule maker, not a rule taker.
Thank you.
Jim yields back. Mr. Panetta, 5 minutes.
Thank you, Mr. Chairman. Mr. Giancarlo, welcome, and thank you for this opportunity for me to ask you questions. Appreciate this chance, and thank you for your preparation as well as your testimony. I have one question, but I got a little bit of a wind-up before I pitch it to you, if that's all right. It deals with the CFTC's enforcement of the impartial access provision. Now, prior to 2008, the swaps market was based on sort of a two-tier system. Went from the client to the dealer to the broker, and then back up that chain. The issue back then was that the dealer and the broker had sort of a relationship where they worked out sort of more of a favorable rate. And the dealer would benefit, but then would charge the client at a much higher rate. And therefore, Title VII of the Dodd-Frank, which was, crafted by this committee, changed it from a two-tier system to a one-tier system and put in a middleman for these standardized swaps, what they call them, and they're known as the Swap Execution Facilities, SEFs. Now, they're supposed to be impartial and anonymous, reduce discriminatory pricing on these swaps, and require no customization whatsoever. And in fact, the CFTC's SEF rule mandates that a SEF must ensure impartial access to its markets and market services for eligible participants. And that eligibility itself must be set at an impartial, transparent, fair, and non-discriminatory manner. Now, one of these eligible participants from my state of California would be CalPERS, the state agency responsible for managing retirement accounts for public employees. And by ensuring impartial access to CalPERS into this market, they and the 1.6 million Californians who depend on CalPERS, including myself in a past employment that I had, for their retirement and health benefits, they stand to gain. In your written testimony, you state that the goal of the CFTC is to oversee a U.S. swaps regulatory framework that has the optimal mix of well-considered rules and regulations that best foster open, transparent, competitive, and financially sound derivative markets to support American economic growth, job creation, and prosperity. However, the SEF marketplace as it stands would not be fairly described as one where impartial access is the rule. Rather, it is the exception. My question, why is the CFTC not ensuring impartial access to SEFs for standardized swap trading?
If we will pursue failures of SEFs to impose impartial access as appropriate. That is a rule that we take seriously, and we will. More broadly, we believe that Congress took a very organic approach to market development in Title VII and did not dictate the form of market structure. The science of platform economics teaches that there's many different market structures and marketplaces. There's many markets that have wholesale and retail market structures, from the automobile market to many other marketplaces. And so I don't view Title VII as requiring an all-to-all marketplace. In fact, the swaps market is not a retail market. It is restricted to what's called eligible contract participants. It is a professional marketplace. And many professional marketplaces have wholesale elements and retail elements. However, I entirely agree that with whatever the market structure that evolves organically in the marketplace, the impartial access requirement is a fundamental requirement in that marketplace, and we will enforce that requirement as appropriate as and when we see it.
And do you see that happening anytime soon, or when do you think that's going to happen?
Well, if we see a violation of it, we will respond to it.
Thank you. Appreciate it. Thank you, Mr. Chairman. You'll be back.
Gentleman yields back. Now recognize past chairman of the Agriculture Committee, Mr. Goodlatte, for 5 minutes.
Thank you, Mr. Chairman. Mr. Giancarlo, thank you very much for appearing today. I appreciate it very much. I'd like to follow up on line of questioning by Mr. Lucas earlier with regard to the recent Treasury report released just last week, where they observed that the regulatory distinction between swaps and security-based swaps did not reflect previous market practice, and the resulting split jurisdiction between the SEC and the CFTC has posed challenges for market participants. Large market participants have expressed their concern over being subjected to unnecessary costs and duplicative oversight by both the CFTC and the SEC, and have observed that it would be much more cost-effective for market participants and the derivatives market as a whole to adhere to one set of rulemakings. As we sit here today, more than 7 years after the Dodd-Frank Act became law, the CFTC has largely implemented its swaps rules, whereas the SEC has yet to do so. Why would not right now be the right time to reconsider how we've divided swaps jurisdiction between the two agencies? Especially since you've done your homework, or your agency.
I think any time is right to reconsider whether a particular part of the statute may have been ill-advised or cause over complexity. An example is in the credit default swaps marketplace, where a trading desk that may engage in credit default swaps will have both on the desk those trading single-name credit default swaps and those trading credit indices. And yet, if they're trading one product, they're subject to SEC regulation, that is single-name credit default swaps. If they're trading credit indices, they'll be subject to CFTC regulation. And since sometimes these indices have different components in them, if it's 10 or less, it's SEC regulation. If it's 10 or more, it's CFTC regulation. And the components can change. So you can have a trading desk that the division between who their regulator is can shift. And yet in real time, they're trading the marketplace. So yes, some of these definitions I think are overly complex, especially more complex by the fact that we have our rules set in place and the SEC is still doing it. I do believe there are other products, however, in the securities-based category that probably are suitable for the SEC, such as equity-based derivatives. So I think if Congress were to take up the challenge of reconsidering this, I think both I and Chairman Clayton would be pleased to participate in this in an informed fashion to get the optimal mix of what should be SEC jurisdiction, what should be CFTC jurisdiction, and perhaps we don't have that optimal mix today.
Let me ask another question related to Mr. Lucas's line of questioning. You talked about the financial stability of some of the commodity exchanges and what is the best way to deal with a collapse of one of those exchanges, which we certainly hope doesn't happen, but it can happen. Have you had the opportunity to look at the legislation passed by the House, which originated in the Judiciary Committee, which I chaired, dealing with a new way to handle large financial institutions in bankruptcy? It's primarily focused on banks that were considered to be too big to fail. But I'd like to know whether you have looked at that, whether you know anything about whether that could work for these types of institutions, or whether something else could be done, or whether that legislation could be tweaked to make it work better, to be prepared in the event that there is a need to liquidate an exchange.
Thank you for that. I'm aware of the existence of that legislation. I apologize that I am not conversant with the details. What I did note in it is that, from my perspective, you appear to be saying, okay, Title II of Title VII was passed in the wake of a crisis. It was rushed, and it was rather wooden, perhaps crude in its approach. How do we fine-tune this in a more thoughtful fashion based upon what we've learned and get to an outcome that's a better and more refined outcome? And I think that's where we need to go with some of our systemically important clearinghouses in the swaps area. Title II is a rather wooden and really bank-centric approach, and yet we need something much more tailored to clearinghouses, which in the event of a resolution, which is highly unlikely, need a more, I think, a long-term solution than simply taking them out of the market. That could cause tremendous market harm. They need to be operated for the health of the markets, perhaps for a long duration, and that's not really possible under Title II of Dodd-Frank as I read it today. So a more refined approach, I think, would be very welcome.
Well, I would be interested if you would take a closer look at that and give us your thoughts, and I would be happy to make available the attorneys on our regulatory reform subcommittee that deals with bankruptcy law to hear your thoughts on anything we might be able to do in that area to make it work better for other types of financial institution failures.
We'll do that, Congressman, and we'll be in touch with your office on that. Thank you.
Thank you, Mr. Chairman.
Gentleman's time expired. Ms. Blunt Rochester, 5 minutes.
Thank you, Mr. Chairman, and thank you so much, Mr. Giancarlo, for being here. My question is a little different than some of the other ones that you've heard this morning. Congress will once again face a vote to lift the debt ceiling. And at our full committee hearing on clearinghouse resiliency this year, we heard a great deal of testimony regarding the paramount importance of U.S. Treasuries to the clearinghouses and thus cleared markets you oversee. Some of my colleagues in Congress, including colleagues on our committee, have publicly stated that their belief that failing to raise the debt ceiling would actually, quote, not be that big a deal. Would you please describe the impact of such a failure on the markets the CFTC oversees?
I think all parties probably would agree, and I certainly would agree that widespread concerns that the U.S. Would not make payments on its securities would be harmful to markets and certainly would affect their usefulness as collateral in our clearinghouses to support swaps transactions.
Given the nature of this, and you know, I watch CNBC, I love this kind of stuff, but the thought of what this could mean to our country, as you describe it, and also as I hear about it, and kind of the pain that it would inflict upon us for what seems to be maybe political. In the end, can you tell us, do you think it's time to end this practice? Do you agree with the president that it's time to abolish it?
As a head of a regulatory agency, I'm loath to tell Congress how it should conduct its affairs. These are important instruments in the marketplace, but how Congress organizes its funding and how the debate goes, I'll leave to those who have stood for public election and represent their constituents, and will make those decisions as they see fit.
Well, I appreciate your having confidence in us, and we have confidence in you as well. I mean, so that's one of the reasons we ask your opinion on something like this, and particularly since it's something that the president himself has said it's time to abolish. So I was just curious if you agree with.
So I truly do believe that the creditworthiness of the United States government is vitally important to both our domestic and global financial markets, unquestionably.
Great. And I'm going to shift a little bit because I have the same kind of questions that the two Mr. Scotts and Mr. O'Halloran had about fintech, and I was really interested in what you said about the study and how we compare it to other countries, and where you said that we're #1 is on the financing and access to talent, basically, and where you said we're falling behind, or are the last, is on the regulatory environment. And I was just curious if you could just share with us things that you think we need to do, your agency needs to do, so that we move ahead and move from the bottom, you know, to the top.
Yeah. So one of the things that was cited in the study that I mentioned as a very optimal outcome is what the Brits do. So there is a coordinated program between the Treasury, the Bank of England, and the market regulator, the FCA, on this Project Innovate. They work together. So innovators can do pretty much one-stop shopping when they talk to the regulators and the government about their innovations. Now, I also think they're very prudent about the way they go, but they don't just simply say, oh, new innovation, great, knock yourselves out, go for it. They're very diligent in how they approach these innovators. They work with them carefully. They're not going to willy-nilly make rule changes simply because some new innovation's coming around. But the innovators know from day one where they stand when they speak to the British regulators. And the same is true in Singapore and Hong Kong, in my experience. That's not the approach here. What we have here is an alphabet soup of regulators. Some of us have, we have our lab, CFTC. Others have no place for innovators to go. And I've heard some stories about one innovator that went to one regulator and said, well, we want to try something new. And the regulator said, well, you can't. Our rules don't allow for it. And they said, but this is potentially really beneficial to the market. And the regulatory officer they met with said, well, simply, maybe our rule will change, but for now, that's the way it is, end of story. That's not the reception they would have gotten in the UK, and that's not the reception we want to give in this country. We're the home of innovation. I mean, we created the internet. We should be a place where innovators receive a warm and intelligent reception, thoughtful reception, a cautious one. We always need to be cautious, but a thoughtful one, and that's where we need to get to.
Gentlelady's time is tired. Mr. Fazio, 5 minutes.
Mr. Chairman, thank you for that. And Chairman Giancarlo, thank you for being here today, and I've enjoyed your testimony. Mr. Bost, unfortunately, asked the question I was thinking of, but picking up on what Ms. Blunt-Rochester just said, I'm wondering if you could blue sky with us for a moment. If we do not modernize our regulatory pattern and approach, where do you think these markets will be in 10 years, and what risk do we have domestically if we do not keep up with innovations and regulatory reforms which may be taking place in other markets around the world, Singapore and other places?
So actually, when I spoke to an official from the Monetary Authority of Singapore, they told me that they modeled their approach to innovation on the U.S. And I said, on us? And they said, yeah, but 20 years ago. We modeled it on the U.S. in the 1980s when a thoughtful Congress and the White House got together and said the internet is happening here. Why don't we take a first do no harm approach to the internet and encourage its innovation in the United States? And so foreign jurisdictions are taking a page out of our book, and we're not following our own good example in this way. And so we're seeing big innovation environments develop offshore in England. China has devoted a whole province and funded it to develop this new distributed ledger technology, and its leading university in that area is receiving government money. China is so committed to these the market innovations. We need to have just some portion of that same fortitude and determination, and we would do equally as well, if not better, because so much of the science is here, so much of the funding is here. But we need the same regulatory approach. We need an open regulatory approach.
So let's try to bring this to a practical, to the average person who might be watching this out in America, to our consumers, to our farmers, to our businesses. What are the practical implications if we don't modernize and reform?
Well, we fall behind. Our markets, the big context here is that other countries view markets as vital national interests. The Chinese are the largest consumers of cotton in the world. They're the largest consumers of precious metals in the world, the largest consumer of rare earth metals. And yet all of those commodities are priced in Western markets. And they say to themselves, but we consume those products. Why are they not priced in yuan? Why are they priced in dollars? They would love to own those markets. They would love to have those markets. We need to have the same approach to our markets as vital national interests that other countries see as vital national interests.
But persuade the consumer out there. Tell the American consumer, what does this actually mean to them?
I was in a grain elevator in Montana a few months ago, and the grain elevator operator showed me his chart of his prices, and all of his prices were coming off of prices traded on the Chicago Mercantile Exchange. So when a farmer in Montana goes to the grain elevator, the price signals, even if he's not hedging in his markets, the prices are coming from American markets. Well, let's say those markets, however, move offshore, and the prices are not coming from Chicago, but are coming from Shanghai. That's why these markets are vitally important, because our consumers can rely on American markets to set the price for their production.
So in other words, there's less volatility in terms of what the predictability of prices could be, because they're priced in dollar denominated, not foreign denominated. So what does that mean to a consumer in the grocery store looking at the cost of various staples that they buy each week?
So when any of us go in the grocery store, we enjoy the luxury not having to stop for a minute and say, wow, I wonder if it was a good condition on the American farm. I wonder if it was a good growing season, because I want to know if there's going to be fresh vegetables when I get to the vegetable section, or if there'll be bread on the shelves. We enjoy that luxury of stable prices, and it's not just in our groceries, but in our 30-year mortgage. We're the only country in the world that, as the standard home ownership tool, uses a 30-year fixed-rate mortgage, because our interest rate swaps market will enable our banks to hedge the risk of variable interest rates. Same thing with our heating oil. All our energy products are priced in dollars. If we're priced in foreign markets, without our strong regulation and priced in different currencies, the consistency we enjoy in our Western way of life would be dramatically changed.
And I think this is the critical ingredient that we need to drive home to the American consumer as to the importance of modernization of these rules, because it provides more predictability and stability to prices here for our consumers, our businesses in the United States. Thank you, Mr. Chairman. I yield back.
Chairman yields back. Ms. Adams, 5 minutes.
Thank you, Mr. Chairman, and thank you to the ranking member, and thank you very much for your testimony. The new self-reporting and compliance approach that you outlined in your testimony does not provide a formula or benchmark for the benefit a company may derive from self-reporting. An earlier draft of the new advisory specified a reduction of up to 75% of the total penalty, but the final version simply said that the company will see a substantial reduction in their penalty if they self-report. So how do you expect companies to calculate the benefits of self-reporting without specific numbers, and will CFTC be issuing further guidance?
Thank you very much for that, Congresswoman. Some of this is a iterative process. We will learn as we go. You know, the program we have in place is not a Republican or a Democrat program. In fact, in many ways, it's based upon programs originated under the Obama administration at the Department of Justice and the SEC. In fact, what we have at our commission was built upon some deferred prosecution procedures that were put in place by my predecessor, Chairman Massad. And the program we have was put forward jointly by me and Commissioner Bowen, my Democrat colleague, over the last few months. So what we're doing has a great deal of precedent in the prior administration and support by my former fellow Democrat on the commission. But what we're trying to do is build into this gradually. We're going to learn as we go. It's new for our commission, even if it isn't new in other parts of the federal government and other law enforcement agencies. So we're going to learn as we go what is the right level. And some of that level of redress in our penalties will be built upon the degree of cooperation we get from firms. How fully do they disclose to us the wrongdoing? How cooperative are they? If they're not fully cooperative and don't fully disclose, then all bets are off.
Thank you. So under the new self-reporting and compliance approach to enforcement that you outlined in your testimony, will every self-report to the CFTC result in an enforcement investigation?
They have to report to the Enforcement Division.
Okay. So the Security and Exchange Commission's information technology budget last year was significantly higher than yours, and yet the SEC suffered a significant cybersecurity breach of its EDGAR system. So cybersecurity breaches like this have become common. Just last week, we learned about more breaches at Equifax and Yahoo. So do you feel that your agency has sufficient resources to prevent a future cyber attack or to respond to one if and when it occurs?
Thank you. I want to be very careful to say that there will never be a successful attack. I will tell you that we currently encounter about 10,000 attacks on our agency's systems per month. That is a lot of attacks, and I can't say that someday some one of them won't be successful. But I can tell you that we will do everything we can. Since I've been chairman, I've initiated a number of new cyber procedures. So the first thing is I now meet with our chief cybersecurity officer monthly, and I review with them the nature of those attacks, whether we're seeing any changes in the attacks, whether there are any significant attacks that he wants to bring to my attention. We also review latest developments in our own cybersecurity defenses. Secondly, a few months ago, we initiated the first ever agency-wide cybersecurity drill, where we created a hypothetical cyber attack on our marketplace, and then we drilled our senior executives to see how they responded to it. There's an old adage in the U.S. Army that says you fight as you drill, and so we are going to be drilling a great deal at the CFTC from here on out. And then thirdly, as I mentioned to you, we now are doing a full inventory of our collection of personally identifiable information to see where we can either eliminate or reduce the collection of it, and where we do feel we do need to collect it, what would be the best way of protecting that information.
Thank you very much. Mr. Chair, I yield back.
Gentlelady yields back. Mr. Thompson, 5 minutes.
Chairman, thank you, and Chairman, welcome. Thank you. Glad to have you here. Many of the CFTC regulations are rooted in outmoded expectations of how business is conducted, such as trading futures in pits that no longer exist, or through floor traders that that have no floor. What are you doing to help CFTC's regulations catch up to modern business practices?
So this is why we've designed Lab CFTC. The first thing we need to do is really understand the impact of this digitizing financial marketplace, and how is it changing the dynamics? Who are the new players? How are they interacting in the market? How are they using technology? So Lab CFTC is our outreach. It's our way of interacting with them to understand what they're doing. But then secondly, how can we maybe use some of those technologies in what we're doing to keep us, and to allow us to keep pace with the innovation? Secondly, we're really looking to get back to solid econometric work at the agency. I must say that one of my biggest disappointments of the agency is the way in which the Office of Chief Economist is allowed to wither on the vine over the last few years, and we really want to build that back up. If we're ever going to understand these changing markets, we need world-class economists helping us understand it. I'm not someone who wants to make policy changes based upon the latest anecdote or the latest newspaper article. I really want to make it on sound science, sound understanding of how the markets are changing, and therefore that should drive what the policy response is. So before I can just spout and say, well, we're going to do this about algos, or we're going to do this about automated trading, I really want to understand what the impact is, and that should then drive what do we need to do as a policy response.
As a follow-up to that, at least at this point, what legislative changes do you need to implement your priorities and to help better manage the agency?
So there's a number of things that we've been looking at. One of the things there's a couple of things the SEC does that we would like to emulate, but we have some statutory prohibitions. The SEC is able to second employees with other regulators here and abroad. I mentioned that about 75% of the global swaps market is cleared in London, and yet we have no one in London. If there's a crisis overnight in London, we're 5 hours behind. By the time we wake up and get our arms around it, it's already happening. I would like to be able to second an employee to the Bank of England or to the Financial Conduct Authority, and I've been invited to do so, and yet we don't have statutory authority to do it. It's something we'd like to look at. We also would like to be able to, in our Lab CFTC, we've been invited by some of these new innovations to participate as a participant in some what they call proof of concepts, or these beta tests of some of these new developments. And yet, if we were to accept that, it would be accepting a contribution to the government. It would have to go through a procurement process. We'd like to see whether we can have the same ability to participate in those the way that our fellow regulators abroad do. The Brits participate in these programs all the time. We'd like to see if we can do the same thing the British regulators do. We mentioned OLA, the Organized Liquidity Facility. We would like to, Orderly Liquidation Facility, we would like to work with Congress on if there will be changes in that, how do we tailor that for our clearinghouses. There are some areas in the Treasury report where they're concerned about financial end users. We'd like to look at that. Insured depository institutions, some of the language there could be improved. So there's some areas around the edges that we'd like to work with this committee and with Congress as we go forward that we could find some ways of improving things.
Given, that we know that qualifying for end user exceptions can be burdensome and complicated, and even Treasury recently released a report recommending legislative amendments. How would you suggest we simplifying the clearing and margin exemptions for end users?
Broadly, one of the most important elements of Title VII was to exempt end users from it. End users were not the cause of the financial crisis, and yet so much of the rule is falling on them. I think this is an area where we really need to focus. I think the Treasury report called on us to focus. And there's a number of areas where I think we can make some improvements. I mentioned the insured depository institution relief, and certainly financial end users as well as perhaps areas where the rules have been overly broad and overly restrictive, goes against the fundamental decision that was made in Dodd-Frank to exempt end users from its reach. And so I think it's an area where we really need to bring our best thinking and think about what we can do to get that right.
Thank you.
Gentleman's time expired. Mr. Soto for 5 minutes.
Thank you, Mr. Chairman. And Chairman Giancarlo, congratulations on your recent confirmation. I wanted to get a sense of sort of your philosophy on the scope of what our future trading universe should be. So can you give me your philosophy on the scope as opposed to what crop insurance does or what the Wall Street and the stock market in New York does? Where is the boundaries of what we should be doing with the futures trading?
Thank you very much, and nice to see you again. And my heart goes out to the people of Puerto Rico. I know it's a concern of yours. And
thank you.
These markets are very important to not just end users and farmers and producers that use the markets directly to hedge, but also indirectly, the price of their produce is being priced off these markets. Even if they're not hedging themselves, when they go to the grain elevator, when they go to the distributor, the price they're being offered is set as a spread to the price that product is trading in the futures market. So it's vitally important for us as a regulator to make sure those prices are set fairly, that there's no fraud and manipulation in the markets, to make sure that those prices are the accurate market price, even for those market participants who are not directly using them to hedge, but are affected by the price signals that come out of it. So I think that there's a very important retail level impact of these markets way far away from Wall Street that is our job as regulators to make sure we police and get right.
Gentleman yields back. Mr. Allen, 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being with us today and trying to help us understand exactly how this thing works. Just a quick question on the effect on our community banks, which, my district is largely, particularly with agriculture, dependent on our community banks. And regarding the de minimis, Congress intended to help community banks by excluding from the de minimis calculation swaps between an insured depository institution and a customer in connection with originating a loan. The CFTC interpreted that exclusion very narrowly, and as you examine the de minimis level, will you consider a proper scope of that exclusion?
Absolutely. Thank you for bringing that up, because that's an area that in some ways often gets overlooked. It was one or two errant words or ambiguous words in the statute led to 3 or 4 pages of extensive restrictions in our rule set. And I think that's an area that's absolutely ripe for us to take another look at and simplify. At heart, It's about whether an insured depository institution can make a loan and then hedge the loan. And as you know, if they can't adequately hedge the loan, they may be less reluctant to make the loan or might charge more for it. We want lending and we want hedging. We want these smaller institutions to make loans to their local constituents and then actually properly hedge it so on their balance sheet it's not an exposure to them. So our over-regulation or overwriting of this rule is restricting the very activity that we want to promote in a growing economy. So this is something that's very ripe for us to take another look at, and we will take another look at this.
Good, good. I'm glad to hear that. Well, as you know, commodity prices are, well, farm income's down over 55% over the last 3 years. Of course, 5 years ago, they were at their highest level. And, of course, now they're down. We've got some trade issues that may account for some of that. But how does this commodity, obviously we're hedging in a global marketplace, okay? But then you've got countries that say, like China, that will pay their farmers over $1 a pound for cotton, yet our world market price right now, I don't know, it's probably a little less than 70 cents, which is too low. From a trade standpoint, how do you work with our trade ambassador to deal with how we actually hedge these things?
You're absolutely right. I mean, it's a complicated environment when we operate a free market for the setting of prices in our commodities, and our commodities are no longer face a domestic market, but truly a global market. And they compete against low-cost producers in developing parts of the globe. And yet some of the very the markets that are importing our products themselves have price protection on their own commodities. It's a very complicated balance, and it's one that it's a big challenge, I think, for our trade representatives, as well as our agriculture secretary, who I believe is really up to the job, but it's a big job and a complicated job. I had the opportunity to meet with Secretary Perdue in Montana a few months ago and talk about some of these very issues. I know he's focused on it, and I pledge to him my support on anything we can do, and he knows he's got it and we'll be there for it.
Well, that's good, because it's a big concern out there, really the fluctuation. I mean, even though it's been over 5 years, I mean, it's nearly, impossible. I mean, right now we're obviously planting more peanuts than we are cotton because of the current farm program. But somehow we have got to restore stability in this marketplace for these folks to be able to plan ahead.
Exactly right.
Well, thank you, Mr. Chairman, and I'll yield back.
Jim yields back. Mr. Lawson, 5 minutes.
Thank you very much. Welcome to the committee. And the more I hear you speak, the more complicated the issue gets, which I don't come close to understanding, But what I will say, when financial institutions during the downturn or the financial crisis, holding more contracts than they have cash on hand. And then when the mortgage rate go down and they're not able to meet those obligations, could you I guess you could explain what really happens when they hit that point?
Well, as you know, one of the tremendously important reforms in Dodd-Frank was to standardize the margin that must be provided or must be utilized in transactions for swaps that don't go through a clearinghouse, in order to avoid that very problem that if there is a payout required under the terms of that derivative instrument, that the necessary margin is there to support that position. So that's an area that was a concern during the crisis that I think has been was addressed in the law, and now it's up to us as the regulators to make sure that the way the margin is calculated, the way it's applied, the way it's charged is done in a way that's effective to meet that very concern that you raise.
Okay, well, let me ask you this, because I wanted to comment. A couple of months ago, the large financial institutions was here, and are saying we need a repeal of Dodd-Frank. You know, and from what information that you have given, Dodd-Frank was supposed to provide some relief and regulations. Why, in your opinion, did the larger banks say that it's time now to move away from Dodd-Frank?
Well, those that may have that opinion, it's not an opinion I share when it comes to Title VII. And Title VII is the provision that my agency is directly charged to implement, and I am personally supportive of it, and institutionally as an agency we support it. So I don't know what or who expressed that view, but it doesn't reflect the view of either me or the Commodity Futures Trading Commission. We believe that Title VII, I've said this many a time, I'll say it again, I think Congress got Title VII right, and now it's for us as an agency to make sure we get the implementation right.
Okay. Explain to me, let me see, I saw something else I wanted to ask you about the trade, where there are hedges about the cost, where it's going to stay at a certain level and the price might go down, but there are fees that are implemented. And it's a winner and a loser in this process, according to what I just read. How does, is this a normal practice all the time in trading commodities? And if it makes any sense what I'm saying.
Are you referring to the what's called the variation margin that parties to a trade must post?
Right.
Well, so this is in the futures market. This is a long-standing practice that has survived, you know, one financial crisis after another. It's a very sound practice. It works very well. And it is where we look when we think about how we should then have a variation margin program, and if so, in swaps, and how do we get the balance right. But where we utilize variation margin in the futures world, it's a very sound practice, and I think our clearinghouses do a very good job of calculating it and applying it.
Okay, Mr. Chairman, with that, I yield back.
Jim yields back. Ms. Custer, 5 minutes.
Thank you very much, and thank you for being with us today. Chairman Giancarlo, congratulations on your unanimous confirmation, and I wish you well in your new position. I appreciated the opportunity to meet with you back in April, and I wanted to thank you for our discussion. We talked about your appropriation, which I support increasing, and to your approach to implementing Dodd-Frank and the enforcement of bad actors in our derivatives market. And I want to expand on that enforcement discussion if I could. In your testimony, you outlined several steps you've taken to strengthen the CFTC's mission to deterring fraud and abuse within our derivative markets. And one aspect that I want to hone in on, can you describe in detail which types of penalties, and I want to get at the criminal or civil, will be addressed in the self-reporting mechanism? On the surface, it may appear that the quote-unquote significant reduction in penalties that the CFTC's enforcement division would award to companies may let bad actors off the hook, and so that's my concern. And then as a follow-up, can you describe how this mechanism will hold bad actors accountable and prevent them from trading on the derivatives market in the future if they have been engaged in wrongdoing? And under the new self-reporting and compliance approach, will every self-report to the CFTC result in an enforcement investigation?
Thank you for those questions. We do not have criminal authority at the CFTC. We work with criminal law enforcement authorities such as the Department of Justice if we are aware of what we believe to be crimes, and we report that. We have civil authority, and we pursue that where it leads. In the case of self-reporting, we expect a number of things for self-reporters, and that is complete, candid, and accurate reporting. We expect them to take their own actions to immediately discontinue any bad conduct, and then we expect full cooperation through the process. We will assess, after all that, whether there is appropriate credit for self-reporting. We expect full, as I said, full and complete and candid cooperation with us throughout the process.
So at what point would you make the determination to refer to the Department of Justice if it was criminal in nature?
Yep.
How do you make that decision if you're relying on self-reporting?
Yeah, the same basis we do today in all other matters. If we see criminal activity, we bring in the Department of Justice early on in the process.
And then the other question, I know that you have a strategy for successful whistleblower program that began under your predecessor. I'm wondering if you will continue that program to ensure that we can weed out bad actors, and whether you would substantially increase your standard civil monetary penalty for individuals above the current rate. It's only about $150,000. That doesn't seem like much of a deterrent for people that could be committing fraud and making millions of dollars.
Well, thank you for that. I believe in the whistleblower program. In fact, in my first few weeks as acting chairman, I, in fact, put forward an enhancement of the whistleblower protections for whistleblowers. And I think that stands as a statement of my commitment to that program. We do not intend to winnow down that program in any way. I'd be happy to look at those penalties. That isn't something that heretofore has been brought to my attention, but I'd be happy to look at those to see if they are suitable for purpose or whether they can be increased in any way.
And I guess I would just ask you on an ongoing basis, because I still do have concerns about this self-reporting. If we had relied on self-reporting on Wall Street, you know, we would have probably seen some serious bad actors cause serious harm to consumers across this country. So could we ask you for a reporting back mechanism to this committee on the success of the self-reporting and any outcome from the whistleblower protection program, and just an accounting of your referrals to the DOJ, in other words, a full picture of how this works going forward, so you can reassure us if it's working, or you can make adjustments.
I want to make something perfectly clear. We're not relying on the self-reporting program. We are continuing every form of wrongful behavior detecting activity that we do today, from tips and referrals to our own surveillance process, which I've also enhanced since I've been acting chairman, through our whistleblowing program. All of those remain in place and will continue to be an important source of. This self-reporting is an enhancement to that. And the answer is I'd be happy to have my staff brief you on a regular basis of what we're doing on this. Our new enforcement will be giving some figures on self-reporting once we've got a period of time under our belt, and our whistleblower awards are publicly available.
I think it'd be helpful for all the members of the committee. So thank you, and I yield back.
Ladies, time's expired. Chris, thank you for being here. The term deference is currently being used in the vernacular. I've used it, you have. Could you give us a couple of sentences on what you mean by the phrase deference?
Yeah. It's really a fairly simple concept, and that is that the nation-state regulator is the primary regulator of their domestic clearinghouses, and overseas regulators should defer to the supervision done by the local regulator. What we mean by that is we believe that we are the competent local regulator of our domestic clearinghouses. We've been doing this for 4 decades now, and we work very well with our colleagues in Europe and abroad. But if they have issues and concerns as to how we regulate our clearinghouses, we're their first port of call. We will work with them, we'll cooperate with them, provide them with the information they need to understand how we go about our regulatory duties. And we believe that is the best approach in an increasingly complicated world for clearinghouse supervision.
Well, thank you very much. Any final comments? Well, Chris, thanks for being here this morning. You did make a tactical error. I found it much more helpful when I do a presentation that I introduce my wife right at the start, because I typically get better treatment that way. So appreciate Regina being here with us this morning. Should have got that right in early on, buddy.
Absolutely. Complete tactical error, and she'll make me know it when I get home. My wife, Regina, Giancarlo.
I got you. Well, thank you both for being here this morning and your testimony. I appreciate the evolutionary agenda that you're putting forward with the agency rather than revolutionary. I think it's a good place to be in and in line with where the committee has been on Title VII since its enactment. We're supportive of the goals of Title VII and the efforts to reduce systemic risk, but wary of the way it's been implemented and the impacts that implementation has on market cohesion and liquidity. We can have the best rule sets in the world, but without cooperation between global regulators, we're going to break global risk markets. And I believe that the best markets serve people and businesses who need them and not necessarily the regulators who oversee them. In December 2012, we had testimony from Patrick Pearson, the head of the Financial Market Infrastructure Unit at the European Commission. Mr. Pearson observed, if we don't reach agreement on a sensible cross-border approach, then conflicts, inconsistencies, and gaps will persist. Trades won't take place, trades won't be cleared, and they'll be reported in a fragmented way. Companies in our economies will not be able to hedge risks they will not be able to hedge risks they have to hedge to do business, commercial or financial. I believe that Mr. Pearson was right then and he's right today. And my opening statement, I said this in my opening statement, I'd like to say it again because I believe it's important. Chris has proposed a thoughtful plan based on deference between competent regulators. I think it's the right plan, not just for the regulation of global clearinghouses, but also for all other new requirements that we're imposing on these swaps markets. If we fail to make progress on international cooperation in the regulation of global markets, we just simply won't have global markets. And with that, I again appreciate Mr. Giancarlo being here with us this morning. And if I can find the proper phraseology. Under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witnesses to any question posed by a member. This hearing of the Committee on Agriculture is adjourned.